with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put this show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, January 9th, 2026. Look, before we get started, if you did not hear last week's podcast, it was our 2026 Outlook. I recommend that you just turn this one off, go back, find week ending 01/02, 2026. Listen to the 2026 Outlook. There's a lot of good information in there as far as what we're looking at for this year, where some of our concerns lie, and how we're positioning. So really don't want you to miss that. Not a whole lot to talk about this week except some headlines, so go back and check that out. Hey, look, as far as this week is concerned, what did the markets do? Much more constructive, pushing higher. Dow Jones up 2.3, S&P up 1.5, NASDAQ up 1.8, and the Russell small caps leading the way up 4.6%. We'll talk a little bit more about all of this here in just a moment. Volatility index flat on the week. Long-term bonds as measured by the TLT, they were up 1% this week. So they had a little bit of a better move than we've seen in quite some time. And when you take a look at all the sectors, it was really pretty mixed. Utilities were down a bit. Technology-type stocks were up quite a bit, and semiconductors, things along those lines. But everything else was pretty positive except for utilities. Utilities and real estate, not so much. Everything else was up pretty nicely. And gold and silver, they were up again. Gold up 4, silver up 10 on the week. Look, that excess volatility in silver is something to be really cautious with. I was reviewing some work from one of our technical strategists just this morning, and that extreme volatility usually spells some trouble there moving forward. So keep eyes on that. So what's moving markets this week? Well, let me tell you what was moving markets this week, comrades. Yes, comrades. Let me tell you what happened here in the United Socialists of America, the US of A. Yes, I'm being facetious. Couple headlines that concerned me this week. Some things that were said that was like, was that just said? Was that actually just said? So there was commentary that came out regarding our national defense and the companies that we utilize to build our military apparatus. And the comments were that these companies are no longer do share buybacks and pay certain dividends and bonuses and all these things. In other words, it was instructions from Mount High on how publicly traded companies could spend their capital. That's just not how America works, folks. Now, look, I understand that there can be things to be said there in regards to getting a better deal on our equipment, to get things built faster, better, all of that sort of thing. And you can have those conversations, and there's probably ways to help enact your will in that regard. But I think we're crossing a bridge when we start telling publicly traded companies what they can do with their capital. That's just not America. That's not capitalism. And then on top of that, you had other comments that were made regarding the real estate industry and telling companies that buy homes and rent them out, things like that, that they were no longer allowed to buy houses. No more houses for you. You can't buy any more houses. Houses should be bought by people and people only. I can understand some concerns there too, but again, I think there's ways to address it and deal with it rather than just coming out and issuing decrees one way or the other on how companies can spend their money. It was just awkward to hear them. And then on top of that, after the whole defense thing happened, then it was said that we're going to double our defense spending to $1.5 trillion. And of course, the defense stocks just went straight up on that news. They couldn't go up fast enough. And I was left scratching my head as to wondering, where's that money going to come from? We are still in huge deficit spending. Last year was no better. We have not turned this boat around yet. We are still drowning in debt, and we are spending more money than we're taking in. And now we're going to double our budget in that regard. Look, I think that's a great thing to do. We need to have a strong, powerful, solid defense, but show me the money. Where is the money going to come? You know, it's kind of reminiscent of, it reminds me of these AI companies have been going out there saying, oh, we're going to spend hundreds of billions of dollars with this company, with that company. And the stocks go up like crazy. But the companies saying they're going to do all the spending, they got no money. They have no money. So what good is that, right? It almost sounds a little bit like empty promises to me, and markets moved quite a bit on some of these comments, and I just find all that interesting. There's another comment made this week, another headline, that we are going to spend $200 billion to buy mortgage-backed assets to try to bring mortgage rates down. Look, I think that'd be a wonderful thing. Where the market controls long-term rates and the market's pushing rates higher, there's reasons for it. Manipulating the market is not necessarily the right answer. All these things are just a little bit alarming. I'm a big fan of free markets. I like Adam Smith, the invisible hand of the economy. I'm not really a big fan of the planned economics of China. And it sounds like we had a lot of that being talked about this week. So a little bit alarming. Then, of course, there was the whole Venezuelan thing and Maduro. And I will say that the United States has to do what it has to do. This guy was indicted, evidently doing some bad things. And we have to do what we have to do in that regard. And they did what they felt they had to do. But here's what bothers me about the situation, and I think that is something we should be aware of, okay? Because this market is not prepared. It is not in any way, shape, or form prepared for any, what we would call black swan events, things that just come out of left field and shock this market. And what bothered me about this whole thing with Venezuela is the fact that our administration cited the Monroe Doctrine. So, go back to 1823, President James Monroe. The Monroe Doctrine said, hey, the Western Hemisphere is our backyard. You stay out of it. This is our backyard. This is our side of town. We're the boss over here. We're the sheriff, and we will handle our business on this side of the world. And you, Europe and everybody else, you just stay out. Okay, that's fine. It was needed back then. We were a young country, right? We just gained our independence, et cetera. But by citing the Monroe Doctrine here in 2026, my concern is this. What if President Xi in China, what if he also likes the Monroe Doctrine? What if he says, you know what, that's a great idea, guys. You do what you want to do on your side of the world, in your backyard, and we're going to do what we want to do on our side of the world in our backyard. We also like the Monroe Doctrine, and we're taking Taiwan. Or Russia, yes, we too like the Monroe Doctrine, and therefore we're going to drop a nuke on Ukraine in the next week or two, and we're going to end this thing once and for all, because what's good for the goose is good for the gander. So these things are a little bit concerning, just some of the things that gets said from time to time, how that can be used in the future. And like I say, this market is just not positioned in any way, shape, or form to handle shock. How that shock could come, nobody knows. No one knows, but they're always looming out there. And that's what usually catches people and gets people in trouble. We're well prepared for shocks because I don't trust the market. I don't trust it here in 2026. I think it's expensive. I think that we've got a lot of things in front of us. I think history, if you look at it as a guide, is setting up a lot of red flags to be cautious about. So we're well prepared for any sort of black swan event or things that may rock the markets. I'm not sure everybody else out there is. Anyway, that's not my problem. My problem is your money. And that's what we're focused on here. So we'll see how all that goes. Look, next week, we're going to start getting earnings. And that's what's really important. Look, we had a jobs number today. It was ho-hum. It was a Goldilocks number, really. It wasn't too hot. It wasn't too cold. So the market liked it, right? If it was too hot, that means that the Fed's not going to cut rates anymore. If it was too cold, it means maybe the economy's going off the rails. It was, just right there, just kind of so-so, and the market seemed to like that. But remember, a couple months ago, or maybe just a month ago, Chair Jay Powell said that these numbers he thinks are off by 60,000 a month. Now, if that's the case, it means we lost jobs once again. So we'll kind of see when revisions come out in the future. Anyway, economic growth has been looking pretty strong. Some of the fundamental backdrops look pretty good. We should be getting some big money back here at tax time for most Americans. That's going to be beneficial. And there's some policy changes and stuff that have taken effect that should be good for the economy. But there's also the fact this market's expensive. And you've got to be a little bit more careful when things are like this. And everybody's bulled up. I mean, everybody I hear is just making the case of how great everything is. And yes, I see good things here and there for sure. But I think that people are a little bit too trusting of Mr. Market right now. Next week, as I said, we get earnings. Banks really start to kick into high gear. We did some trimming this week. The bank stocks have been running hot, and they start to report earnings next week. They usually don't perform that well when they run hot into earnings. So we trimmed back Citigroup a little bit this week, just took some profit out. Look, we bought it in August of 2023 for $59. It's $121. So we trimmed that back a little bit this week. We also trimmed back Ulta Beauty for people that have it in their IRAs or if they have a very low tax bracket. We have a model that doesn't care about taxes. We bought Ulta Beauty in March of last year for $344. It's at $659 right now. It's up 10% year to date. It's also running hot. We felt it would be a good time to peel back some profit on that. For all of you that have it in your taxable accounts and you're in a high bracket, that's a different model that we'll be looking to trim it back once we cross the purchase date there in March. You got to wait till March, else you're going to pay income taxes instead of capital gains. And we'll cross our fingers and hope that the gains hold between now and then. That's the risk you take. You got to try to balance out the tax consequences with the potential for the market to pull some of that profit back out of your hands. And then for the smaller accounts that are invested in our ETF models, our exchange traded funds, we also sold the tech sector this week. We bought that in April of last year when the market tanked and made a really, really nice return on it. But again, tech stocks are looking stretched and not been performing well. Look, year to date, the markets are up and stocks like NVIDIA are negative on the year. Negative. Leadership that we've had in recent years is not leading. I mentioned earlier about small caps doing so well this year so far year to date. Look, one of the things that is a little bit concerning, and I mentioned it in the 2026 outlook, watch out for peak concentration. That is when the market concentration peaks, when you got a small group of stocks driving all the returns. When that comes to an end and things start to broaden out, historically, believe it or not, things sometimes don't go very well. There's actually quite a few examples of that. 1905, 1929, 1966, 1999. Anyway, things did not go very well after that period of time. So it looks like that maybe that's happening now. So that's interesting. But again, we've got some conflicts here between technicals and fundamentals. We'll have to see how things shake out. But I like where we stand. We've got nice positioning. We're prepared for black swan events. We're prepared for markets not acting or behaving very nicely. And if they want to continue going higher, we'll participate because we've been participating so far year to date. We are doing just fine. As a matter of fact, our flagship model that outpaced the S&P 500 last year is also so far year to date outpacing the S&P 500, even with all this defense we've got built in here. So I'm pretty happy about that. So I'm going to wrap up. Between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's retire a little early, take that big trip, buy that second house. Hey, you know what your goals are. Don't just think about it. Think big. Think B-I-G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.